Now, let me take you to TradingView so we can look at a real example. This is the British pound US dollar weekly chart, showing the most recent price action from last week. When we examine this weekly chart, we can see that price swept the previous candle's high and then closed back below it. Not only that, price also closed below the previous candle's low. This gives us a clear indication that we should maintain a bearish expectation for the coming week. Since we now have a clear directional bias for the week, we drop down to the daily chart to understand what the daily time frame is likely to do. On the daily chart, we can see the CSS model forming very clearly. Price is sitting inside a bearish internal range liquidity. After internal range liquidity, we should normally expect external range liquidity to be the next target, especially when it aligns with the higher time frame bias. In this case, it aligns perfectly with our weekly bearish bias. Inside this daily internal range liquidity, we then get a candle sweep. Now, because this is the British pound US dollar chart, we check the correlated pair, the Euro US dollar. When we do that, we notice that the Euro US dollar did not sweep the same high. That gives us our Candle Sweep SMT. After this Candle Sweep SMT forms, we can anticipate that the British pound US dollar is very likely to expand to the downside in the coming days. And that is exactly what happened. Price delivered a strong, impulsive move lower, taking out the daily external range liquidity and also the previous week's low.